Welcome to our financial management course. Today, we will be talking about what is a stock. More specifically, we'll talk about what it is, common characteristics, what it means to trade it, what it means to own it, and much more. Let's begin. A stock represents ownership in a company. When you buy a stock, you own a fraction of that company and its future profits. Each share of stock gives the holder a proportional claim on the company's assets and earnings. Stocks are also called equities. Any individual or institution can own stocks, including mutual funds, pension funds, and foreign investors. A common stock gives shareholders voting rights and potential dividends. Common shareholders are the last to receive assets in liquidation, but enjoy unlimited upside potential. Preferred stock combines features of both equity and debt. Holders usually do not have voting rights but receive fixed dividends before common shareholders. Classified stock refers to shares with different rights or voting powers. Companies may issue multiple classes to control ownership. American Depository Receipts allows U.S. investors to buy foreign companies' shares in U.S. dollars traded on U.S. exchanges. A ticker symbol is a unique abbreviation for a publicly traded company's stock. For example, Apple's ticker symbol is AAPL. A listing is when a company's shares are approved for trading on a stock exchange. A dual listing is when a company's stock trades on more than one exchange. Initial public offering is when a private company sells shares to the public for the first time. Seasoned public offering occurs when a company that is already public issues new shares to raise more capital. Primary market is where new securities are issued. Secondary market is where investors trade existing shares among themselves. Securities and Exchange Commission is a U.S. government agency that regulates securities markets. It enforces laws against insider trading, fraud, and misleading disclosures. It regulates exchanges, brokers, and public companies. Stockholder, shareholder, is an individual or institution that owns at least one share of a company's stock. They are partial owners of the company. Stakeholder includes anyone affected by the company's performance: shareholders, employees, customers, suppliers, and even communities. For example, if a factory closes, both shareholders and employees are affected. Both are stakeholders. Investors own stocks for capital appreciation, dividend income, and voting rights. Historically, stocks outperform bonds and inflation over the long term. For example, the S&P 500 has averaged about 10% annual returns historically. A dividend is a payment from company profits to shareholders. It may be paid quarterly, annually, or as a one-time special dividend. Not every company pays dividends. Stocks can be traded through brokerage accounts using market or limit orders. Stocks trade on exchanges such as the New York Stock Exchange and NASDAQ in the US, and globally on exchanges like the London Stock Exchange or Tokyo Stock Exchange. The Board of Directors oversees management and represents shareholders' interests. Directors are elected at the General Assembly, typically serving 1 to 3 year terms. They are usually compensated with cash and/or stock. The CEO, Chief Executive Officer, is responsible for company operations and strategy. The CFO, Chief Financial Officer, oversees finances, reporting, and investor relations. A General Assembly is a meeting of shareholders held at least once a year. It is where key corporate decisions, financial statements, and board elections are approved. All shareholders can attend or vote by proxy. Shareholders vote on board elections, mergers, or major changes. If unable to attend, they can authorize another person or institution to vote on their behalf, called proxy voting. An activist investor buys large stakes in companies to influence management or strategy. For example, Carl Icahn or Bill Ackman are famous activist investors. Stock represents ownership, bond represents debt. Stockholders are owners, while bondholders are lenders. Dividend is discretionary and can change or stop. Coupon payment from a bond is fixed and mandatory as long as the issuer is solvent. This concludes our discussion about what is a stock. See you at the next lecture.